This is the moment the global economy stopped drowning and came up for air. This is the image that traders, shipping executives, and finance ministers across 14 time zones have been watching every single morning for weeks. A live feed of the Strait of Hormuz, 21 miles wide at its narrowest point with nothing moving through it. Ghost water. Silence where there should be the constant, churning procession of tankers carrying the blood of the modern world. And then, as of 6:47 in the morning, Tehran time, on a Saturday that no one in global finance will forget, that silence broke. Ships began to move. Signals lit up on maritime tracking systems from London to Singapore. Oil futures, which had been climbing toward numbers that analysts were calling catastrophic, reversed. Not slowly, instantly. Iran had just reopened the Strait of Hormuz. But what you are about to hear is not a story about ships. It is not a story about oil prices recovering. It is a story about how a single waterway exposed the deepest fault lines in global power, shattered one of the most confident foreign policy strategies Washington has attempted in decades, and handed a diplomatic outcome to a government that the United States had spent months trying to break. In this breakdown, we are going to walk through exactly what happened in the hours before that announcement, what was actually said in private rooms that the public was never supposed to hear, why the markets reacted the way they did, and what those numbers actually mean, and what comes next. Because what comes next is more dangerous than what just passed. Iran did not just reopen a waterway. It rewrote the terms of its relationship with the world. And Washington is only beginning to understand what it agreed to. 3 months ago, the plan seemed straightforward. American officials described it with the kind of calm confidence that only comes from people who have never had a plan fail badly enough to teach them humility. The strategy was maximum pressure, version 2. Tighten the economic screws on Iran until the cost of resistance became impossible to bear. Cut off its oil revenues. Isolate its financial system. And when the pain became unbearable, Tehran would come to the table and accept American terms on the nuclear file. It was supposed to be clean, surgical, the kind of foreign policy success that gets written up in think tank reports and turned into case studies. But the cost of that plan was never just economic. The hidden price was something far more dangerous. The credibility of every promise the United States had made to every partner that depended on the free flow of energy through the Persian Gulf. For decades, the unspoken contract between Washington and the rest of the world was simple. America kept the sea lanes open. That was the deal. That was why countries from Japan to Germany to India accepted American military dominance in the region without too much public complaint. The lanes stayed open. Commerce kept moving. When Iran closed the strait in response to American and Israeli strikes on its territory, it did not just block oil, it called Washington's bluff. And the Trump administration's response, adding its own naval blockade on top of Iran's closure, did not tighten the pressure on Tehran. It collapsed the entire architecture of that unspoken contract. Oil producers could not export. Importers could not receive. The world's energy supply sat locked between Iranian maritime forces on one side and American destroyers on the other. Shipping companies began rerouting vessels around the Cape of Good Hope, adding 3 weeks and millions of dollars per voyage. Insurance premiums for Gulf shipping did not rise. They exploded. Some carriers simply stopped accepting bookings. The administration gambled that Iran would calculate the cost of continued closure as too high to bear. It assumed Iran would blink first. It assumed wrong. At 4:15 in the morning Washington time, on the Tuesday that changed everything, a duty officer at the National Security Council received an alert that no one had officially predicted would come this soon. Iranian state media had announced that the Strait of Hormuz was open for international shipping. No conditions attached to the announcement, no press conference, no dramatic ceremony, just a statement released into the digital night, and then the maritime tracking data that confirmed what the statement said. Vessels beginning to move, tankers that had been anchored offshore for weeks, suddenly logging departure coordinates. For about 11 minutes, there was confusion. Traders in London who were already at their desks tried to verify what they were seeing. Analysts in Singapore pinged each other across encrypted channels. No one wanted to move first on information that might be wrong. And then Brent crude dropped $7 in 4 minutes. Pause. $7 in 4 minutes. That is not a market correcting. That is a market that had been holding its breath for weeks, finally exhaling in a single, violent rush. By the time New York markets opened, Brent was down nearly 11% from the previous day's close. Shipping stocks, which had been quietly gaining as investors bet on prolonged rerouting revenues, reversed sharply. Freight futures collapsed, and in the currency markets, the currencies of the countries most dependent on imported oil, India's rupee, Pakistan's rupee, several African currencies, strengthened against the dollar almost immediately. But while the oil markets were moving, something else was also happening simultaneously. While crude prices were falling in London and Singapore, diplomatic phone lines between Washington and 3 different Gulf capitals were lighting up. Senior American officials were being briefed, and while those briefings were happening, sources in Muscat, the Omani capital that has served as the quiet back channel between Iran and the West for decades, confirmed that the reopening did not come from nowhere. While the world was watching oil prices, the real story was happening somewhere else entirely. And that is where this gets complicated, because the market reaction, as dramatic as it was only the surface of what had just shifted. The deeper shift was geopolitical. The reopening was not a surrender. It was a move. And understanding the difference between those two things is the difference between reading this situation accurately and reading it completely wrong, which is what most of the coverage has done. Analysts at 3 major investment banks, sources familiar with their internal assessments confirm, began immediately revising their year-end oil forecasts downward, not because the crisis was resolved, but because the crisis had entered a new phase where the rules were different. One senior commodities strategist at a firm in London described the internal mood that morning as a mixture of relief and dread. Relief because $150 oil was no longer the base case. Dread because no one was entirely sure what Iran had actually agreed to, or whether it had agreed to anything at all. According to leaks from sources in 2 separate Gulf capitals, the back-channel negotiations that produced Tuesday's announcement had been running for 6 days before anyone in the public was told. The key intermediary was Oman, as it has been before. Sources familiar with the Muscat talks describe a process that was moving in fits and starts, complicated every time Washington issued a new public statement that Iran's side interpreted as an attempt to claim victory before anything had actually been agreed. A senior Omani official, speaking to regional media on the condition of anonymity, said the talks came close to collapsing at least twice. The private calculation in Tehran was cold and clear. Iranian leadership had reviewed the numbers. The closure was costing Iran real money, oil revenues it needed, but the closure was costing the rest of the world more. Every week the strait stayed shut. The economic and political damage to American credibility was compounding faster than the damage to Iran. India was furious. Japan was alarmed. South Korea was sending quiet, urgent messages to Washington. European capitals were openly frustrated. China was watching and calculating. A leaked summary of conversations between senior Iranian officials, reported by a regional outlet with access to government sources in Tehran, described the internal framing this way. The closure had done its job. It had demonstrated capability, demonstrated seriousness, and demonstrated that the cost of attacking Iran was not going to be absorbed quietly. The reopening was not weakness. It was an exit ramp, chosen on Iran's terms, not Washington's. And here is where the elite calculation gets interesting. Sources say that American allies, the very countries whose support Washington had publicly assumed it would receive, had, in private, made their positions unmistakably clear. Britain and France did not merely decline to join the blockade. According to diplomatic sources in Brussels, senior European officials communicated directly to the White House that the blockade was creating conditions that were legally and politically untenable for European governments. The language used in at least one of those communications, sources say, was significantly sharper than anything that appeared in public statements. The White House, according to people briefed on those conversations, did not have a prepared response. To understand why the markets reacted the way they did, you have to follow the money. And when you follow the money in this situation, it leads somewhere that the official narrative does not want to go. The blockade was built on an assumption that is now revealed to be structurally flawed. The assumption was that cutting off Iran's oil revenues would create internal economic pressure sufficient to change Iranian government behavior. But 98% of Iran's oil exports were going to China, not to Europe, not to American allies, to China. Which means the blockade was, in practical terms, a blockade of China's energy supply chain, executed while Washington was simultaneously preparing a presidential summit in Beijing aimed at stabilizing the relationship. That is not a foreign policy. That is a contradiction. And markets do not forgive contradictions indefinitely. The power in this situation has shifted in ways that are not fully visible yet, but will become clear over the next several months. It has shifted away from the model of unilateral American coercion, where Washington decides and the world adjusts, toward a model where multiple powers, China, the Gulf states, Iran itself, have demonstrated that they can absorb American pressure, outlast it, and eventually create the conditions for an outcome that was not Washington's preferred outcome. A retired senior American diplomat, speaking on the record to a foreign policy publication, described what has happened as a textbook case of strategic overreach. The legal dimension of the blockade was always its most vulnerable point. Under international maritime law, interdicting vessels in an international strait is not a gray area. A retired U.S. admiral said publicly on American radio that a naval blockade of another country's ability to export is technically an act of war. That assessment came not from Tehran, not from Moscow. From a former officer of the United States Navy applying the law that his own institution is supposed to uphold. The implications of that legal exposure did not disappear when the strait reopened. They simply moved from an active crisis to a festering one. Here is what the domino effect looks like from here. If the Pakistan talks proceed and produce a framework for nuclear negotiations, then Iran emerges from this episode having closed the world's most critical waterway, weathered an American-led blockade, extracted a reopening on its own terms, and returned to the diplomatic table from a position of demonstrated strategic leverage rather than desperation. That is a profoundly different Iran than the one Washington imagined it was dealing with 6 months ago. If the talks stall, and history gives us strong reasons to expect they might, then the strait becomes a lever that Iran now knows it can pull. And more importantly, the world now knows it can pull it. While European leaders were calculating their next diplomatic move, something else was also happening. While the EU was reassessing its position, Gulf sovereign wealth funds were quietly repositioning their energy portfolios away from assumptions of American guaranteed stability and toward hedging strategies built on the assumption that the next closure might not be resolved in weeks. It might be resolved in months, or it might not be resolved at all. And while those portfolio adjustments were being made, a third thing was happening simultaneously. Indian policymakers who had watched their strategic reserves drain toward 30 days of supply under the blockade were having a completely different conversation in New Delhi about whether the relationship with Washington still provided the kind of security they had built their energy planning around. Reports from people close to the administration describe senior officials who were blindsided by the speed of the reopening, frustrated that the moment of maximum pressure did not produce the capitulation they had expected, and uncertain about how to frame the outcome publicly in a way that did not look like a defeat. Multiple messaging strategies were proposed. Multiple drafts of a public statement were reportedly written and discarded. Sources say the internal atmosphere in the West Wing that morning was one of frantic and not entirely successful damage control. The coalition that Washington assumed would hold, allies, regional partners, international institutions, did not hold. It fractured quietly without drama, simply by declining to be part of something it judged to be wrong. There is a moment in every overextended campaign when the map stops matching the territory. When what you said you were doing and what you are actually doing become two different things, and everyone around you can see the gap, even if no one says it directly to your face. This moment in American foreign policy toward Iran is that moment. The Strait of Hormuz is not just a body of water. It is a mirror. And what it is reflecting right now is not strength. It is the image of a strategy that believed its own assumptions so completely that it never seriously prepared for them to be wrong. You can manipulate news cycles. You cannot manipulate oil prices. You can spin a press release. You cannot spin 14 countries quietly rerouting their energy planning away from dependence on American security guarantees. Reality does not negotiate. It simply accumulates until the weight of it becomes impossible to ignore. So where does all of this actually leave us right now? The strait is open. That is real. Markets have exhaled. That is real. The immediate catastrophe of $150 oil and collapsing global supply chains has been avoided, at least for now. But the structural landscape that created this crisis has not changed by a single degree. Iran's nuclear program continues. Its regional relationships continue. The sanctions architecture that has defined the U.S.-Iran relationship for 4 decades continues. And the fundamental question, what security guarantees is Washington actually prepared to offer in exchange for genuine Iranian concessions, remains entirely unanswered. As we move toward the Pakistan talks, watch for 3 things. Watch whether Washington can offer anything that Tehran would consider a genuine security commitment rather than a temporary incentive. Watch whether the European powers that broke from the American position during the blockade re-emerge as independent diplomatic actors or fall back into line. And watch the strait itself, because a waterway that has been closed once and reopened on the terms of the country that closed it is not the same waterway it was before. It has a new history now, a demonstrated history. The reopening is not the end of this story. It is the end of the chapter in which Washington believed it controlled the terms of every chapter. The next one is being written now, in rooms we do not have access to, by people who have just spent 6 weeks proving that the most powerful navy in the world could not move 21 miles of water. History never announces itself cleanly. It does not send a press release. It does not hold a ceremony. It simply arrives quietly in the form of a maritime tracking update and a $7 drop in oil futures on a Tuesday morning, and then it waits to see what happens next. Subscribe and stay close. Because what happens next is going to move fast. And when the next chapter breaks, we will be here to break it down in real time, the moment it happens.